APAC's asset and wealth management industry recently saw fund managers across the region prepare for a new Trump presidency, Singapore steal a march on Hong Kong to become a digital asset center, Hong Kong alter its capital investment entrance scheme requirements, and China reportedly again ask investors to reduce stock selling. Let's take a deeper look at these, as well as other headlines and developments. And now to China. US investors in Chinese venture capital funds are responding to measures from the Biden administration, which came into effect on 2nd of January 2025, that impose civil and criminal penalties for US entities which invest in Chinese companies tied to semiconductors, quantum computing, or AI systems that may be utilized by China's military. The measures increase the burden of due diligence faced by US investors, with institutions that have money in Chinese investment funds needing to obtain binding contractual assurance that their investment will not be invested in companies which violate the measures. Reportedly, some investors have received such assurances from Chinese fund managers, while requests from others have been refused. Those which receive assurances will need to undertake due diligence to ensure that Chinese funds are adhering to the measures. This is a potential area of concern, as Chinese law allows for countermeasures to be taken against discriminatory sanctions from foreign states. The measures follow a period of rising geopolitical tensions between China and the USA, which are now spilling over into the business and financial markets as tensions converge around areas like technological dominance. 2024 report from the US House of Representatives China Committee, whose remit was recently extended for 2 more years, along with an increase in scope, noted that USA venture capital firms had invested $3 billion into tech companies which had directly benefited the People's Liberation Army. Over the period of 2020 to 2023, the top 72 largest US public pension companies invested a reported $68 billion into China as limited partners. Already, several US-based venture capital firms, such as Sequoia Capital, Golden Gate Ventures Capital, and Matrix Partners, have split their China-focused entities off to avoid incurring the ire of US regulators. The measures come as China's VC space finds itself crippled by government and regulatory guidance, with government guidance funds now overpowering traditional private sector LPs in the space, according to some VCs. The GGFs reportedly impose onerous conditions on their GPs, dictating returns, sectors, and specific companies to invest in. They do so as they are under pressure to not lose money, and they utilize VCs as vehicles to drive investments into industries selected by local and national policy. Moving on, the Shanghai and Shenzhen stock exchanges have reportedly reached out to several large fund managers, beseeching them to limit their selling of stocks at the start of 2025 in an attempt to calm markets as China navigates a turbulent period. The FMCs were reportedly specifically asked to ensure they bought more shares than they sold across several days. The guidance would mirror similar efforts made in 2024 when various financial institutions' stock selling efforts were curtailed, and reflects concerns of market participants that such guidance has a tendency to become regular. The CSI 300 declined 2.9% on its first trading day of 2025, its worst start to a year since 2016, and lost over 5% during the first trading week of 2025. The move comes amid President Trump's threats of tariffs on Chinese goods that are driving down mainland bond yields and stock prices, and have seen the renminbi fall to its lowest level against the US dollar since 2023. This has led to the aforementioned bourses and PBOC, China's central bank, taking additional measures to arrest the declines and attempt to revive the Chinese economy. These measures include deploying 800 billion renminbi in swap and relending schemes to bolster investor confidence and give support to stock prices. Many market participants and observers were waiting until Chinese New Year to reassess their level of confidence in the moves. Whether they saw enough positive news remains to be seen. Next up, China's beleaguered pension system faces yet another challenge: workers not paying into it. It is estimated that tens of millions of workers, mostly those in their 20s, are opting out of China's basic pension insurance by choosing to suspend their contributions, just as the payments the funds are required to make are expected to rapidly increase, with 20 million workers retiring annually over the next decade, birth rates plummeting, property prices falling, and a lackluster economy. Authorities in Beijing are taking steps to try to address the situation, announcing in September 2024 that the age of retirement would gradually increase from 1st January 2025 so that men retired at 63, up from 60, and women would retire at 55, up from 50. Some see the measures, which were identified in 2019, as coming too late for millions of workers who, unless they have private pension savings or investments, face a retirement of penury. The rising tensions from younger workers stem from the view that their contributions are being put towards generous payouts to insiders and that there will be no money left once they stop working, something that their counterparts in many Western nations can relate to. Other vagaries of China's pension system mean that the amount people receive in their retirement is not clear. The growth of participants, as well as inflows into China's basic pension, has slowed in recent years. Net inflows over the first 10 months of 2024 increased 2.3% to 542.3 billion RMB, down from double-digit growth seen in the 2 years prior. The decline in contributions may see the fund, into which urban workers contribute, depleted by 2035. The fund currently serves 460 million people, and its assets are expected to peak at 7 trillion RMB in 2027. While many countries face demographic challenges, China's are especially severe, with circa 400 million people over the age of 60 expected by 2035. This would amount to approximately 29% of the population. Further, as of 2022, it was estimated that there were more than 200 million flexibly employed workers in China, nearly 1/4 of the total workforce, which could double to 400 million by 2036. A reported 40 million of these workers have not made contributions to their voluntary pension scheme in recent years, with 38 million choosing not to do so in 2013 alone. The fund that these workers pay into is forecast to go into deficit in 2028, with the shortfall rapidly growing to 11.3 trillion RMB by 2050. New workers are unlikely to be around to carry their retirement costs, with China's birth rates continuing to decline despite the introduction of the three-child policy in 2021. Employers are also failing to adhere to pension requirements, with the 2024 survey indicating that only 28% out of over 6,000 firms surveyed were fully compliant with their social security support to employees. In addition to raising the retirement age, measures designed to boost contributions, accelerate the transfer of state assets to pension funds, and establish new state-level pension funds have also been floated. Some of these will likely face opposition, as it will mean reduced government spending elsewhere. Despite the despondent mood among China's youth, many are taking savings into their own hands, making regular contributions to private pension schemes. Some are warning against not contributing to the formal pension schemes, noting that it would be very foolish for young people to opt out, noting that the government has enough assets to back any future payments and that no country would ever default on their pension. Whether this is true and whether reforms can bring China's youth back into pension participation remains to be seen. So that is this episode's section on China. Check out our profile for this episode's other sections and let us know in the comments if there was an important development that you think we missed and should have been included. Many thanks for watching. Hope to see you next time.